Okay, it's official, or at least that's what we're being told. On May 15th, 2026, we're about to see, or supposedly about to see, the biggest economic shakeup of the decade. Okay, a new Federal Reserve chair, lower interest rates, more money printing, higher inflation, and really a complete reset of the monetary system. Okay, that's the narrative spreading right now. So today we're going to slow this down and separate what actually changes from what physically cannot. Okay, because most of what you're hearing, I think, is based on a misunderstanding of how the Federal Reserve really works. Okay, let's start with the first myth. Okay, the idea that the president controls the Federal Reserve. The claim goes a little something like this, okay? The president appoints the Fed chair, therefore the president controls interest rates. It's a logical sounding thing, but it's very, very wrong. Interest rates are not set by one person, okay? They're set by the Federal Open Market Committee, okay, the FOMC, as people say. That committee has 12 voting members, okay, 7 Federal Reserve governors and 5 regional Federal Reserve presidents. So to change interest rates, you really need a majority vote, okay? Not loyalty or alignment or, a political belief. You need consensus. Okay, so even if a president appoints the Fed chair and several governors, they do not appoint the regional Fed presidents. They don't control inflation math. They don't control treasury issuance. And they don't control global dollar demand. Okay, the Fed chair manages the meeting. They do not override the votes. So changing the chair does not change the physics of the system. Which brings us to the second myth, okay? Lower Fed rates mean lower mortgage rates. This is a very intuitive sounding one, okay? And I think that's what kind of makes it dangerous. Because it's only partially true, okay? There are two different rate worlds, okay? You have policy rates and you have market rates, okay? The federal funds rate is a short-term overnight rate that banks charge each other. Okay, that's a very broad statement. But your mortgage isn't priced off that. Okay, it prices off long-term treasury yields, mortgage-backed securities, inflation expectations, and risk premiums. Okay, very important. That's why the Fed can cut rates and mortgage rates can stay high or even go higher. If inflation expectations rise, okay, long-term rates don't care really what the Fed wants. Okay, markets price future risk, not political intent. Okay, lower Fed rates do not guarantee cheaper credit. Okay, let's talk about the third myth, okay? And that more political influence means unlimited money printing. This myth confuses tools with constraints, okay? The Fed does not print money freely, no matter what you hear. It expands its balance sheet by swapping reserves or assets, okay? That process is constrained by treasury issuance, collateral availability, bank balance sheets, and inflation expectations. Okay, the Fed cannot print real resources. Okay, it cannot force the banks to lend to each other or lend at all, and it cannot override market pricing. Inflation is not controlled by speeches or appointments. Inflation really controls the Fed. Okay. And I'm moving through these quickly, but I want to talk about biggest myth of them all. Okay, that May 2026 is a reset of the system. Okay, that is not true. Okay, here's what actually changes. Okay, the tone, the bias, the tolerance for risk, the speed of reaction. Okay, here's what does not change: debt levels. Okay, treasury issuance, global dollar demand, market discipline, and inflation math. This is, not some kind of revolution. Okay, it's stress management inside an already leveraged system. Okay, the Fed is reacting. Okay, not leading. Okay, if you really want to understand what matters, I think you need to not ignore the headlines, but think about them through the lens of the system. Okay, watch long-term treasury yields, watch inflation expectations, watch dollar funding stress. Okay, watch repo markets and reserve demand. That's where the system speaks honestly. Okay, the myth is kind of emotional. Okay, and but the reality is mechanical. Okay, changing leadership does not change incentives, does not change balance sheets. Okay, it changes how the system responds under pressure. So if this helped you understand roughly what's really going on, let me know in the comments, okay? And if there's anything that you want to know, or that you want to understand a little bit more, I would love to hear about it, okay? Because once you understand the system, okay, I think the fear can subside a little easier. It is a scary world out there, and there is a lot going on, and I think that's what makes it so much more important to focus on how the system functions, because you're able to make decisions for yourself. You're able to analyze your own risk. Okay. And I think that is worth its weight in gold, or money. So I want to thank you for watching our Mythbusting episode today. And again, if there's anything you guys hear, a narrative that sounds scary, overwhelming, or anything that is bringing you some distress, let me hear about it. Tell me about the topic. You don't have to share the video, but just ask the question, and I will put it on our list to cover it. And once again, I'm Justin, and thank you for being here.